every major variable that dictates and sort of informs what's going to happen to housing prices was pushing upwards on housing prices. When the market is in a correction, I know that's when everyone says like, oh, you shouldn't buy. But when a market is in correction, that is also the literal definition usually of a buyer's market. 2023 is going to offer some really interesting opportunities for real estate investors. But to invest confidently and conservatively in a market like this, which is confusing and is also in the state of a correction, you really need to understand the fundamentals of the housing market, how we got where we are today, and what's likely to happen over the next year and the next several years. And to help you understand these really important and often confusing things, I developed a 2023 State of Real Estate Investing report. It spent months researching, analyzing data to give you the information you need to make confident investing decisions. What's going on, everyone? My name is Dave Meyer. I'm the Vice President of Data and Analytics at BiggerPockets, and I've been investing in real estate for over 12 years. And if you watch this channel frequently, you know that my thing is to look at the housing market, to look at data, to try and understand what is likely to happen next so you and I both can make informed investing decisions. If you like what's in the video, which I'm about to show you, you can download my full report completely for free at biggerpockets.com/report. That's biggerpockets.com/report. We'll put a link in the show description below. But in this video, I'm going to show you some of the highlights. We'll go through some of the most important factors that have led to where we are today, some of my predictions about 2023, some open-ended questions for you to think about in your own portfolio development, and 10 recommendations for how to invest in 2023. Let's get into it. All right, I am going to screen share and I'll show you the actual report that I wrote. And if you want to grab this report, just do that on biggerpockets.com/report. And as you'll see, this thing is a doozy. It's actually 61 pages. It's not like book length. It won't take you like hours to read, but it probably will take you like 20 or 30 minutes to read. But I promise you, it is worth it. I'm biased. I wrote this, but I really think that this is really good information for anyone who's considering making a large investment into real estate next year. So here's the thing. The housing market and where we are today, I think when we look back at 2022, you can't really describe the entire year as one thing, right? The first half of 2022 and the second half of 2022 were almost entirely different housing markets. And so when I provide this first section of context, I actually split it out into two different time periods because describing 2022 as a whole isn't useful. Instead, I think what we need to do to really understand how we got here, how we got to the housing market we're in today, we need to look back to the beginning of the pandemic. So in this first section of the report, I describe what happened from February of 2020 to June of 2022. And those, 28 months, really were one of the craziest housing markets we've ever seen. And there are no single variables, no single data point that predicts what's going to happen in real estate. There are several of them, and I'll just name a few of them. I go through them in detail in this report, but you can see supply is one of them. Inventory is another one. These are measures of how many houses are on the market, how many total houses are in the entire United States. Demand is hugely important. How many people want to buy houses? How many people can afford to buy houses? These are all some of the most important variables. And if you want to read about each one and how they contributed to rising home prices from February of 2020 to June of 2022, you can get that in the report. But what you need to know, at least in terms of the highlight section here, is that every major variable that dictates and sort of informs what's going to happen to housing prices was pushing upwards on housing prices. When I talk about housing markets, or really any market, stock markets, bond markets, whatever it is, there are different forces in play. Like I said, no one variable determines what's going to happen in these markets. And I sort of think of it as a scale, right? So there's all these variables in the housing market. We just talked about what the big ones are: inventory, demand, affordability, bond yield, stock gains, supply. All of them were on the side of the scale that were pulling prices up. That is unprecedented, really, at least in my research, that every single major variable was pushing prices up. So I know it seems like in that time period, it was a traditional bubble where people were acting irrationally and things were going crazy, but that's not really true. There was sound economic reasons and there was macroeconomic conditions that really, really supported that. If you look at this illustration here that we put in the report with the scale, there really was nothing tempering that for like 28 months. There was nothing putting downward pressure on housing prices because affordability was really good. People could afford to pay more and more and more because mortgage rates were so low and money printing was happening. So people had more cash in their pockets. So it created this perfect storm for prices to go up. Now, when we get to June of 2022, that's when things really start to change. And I think we all know why, right? It's because the Fed started raising interest rates. And that, of course, impacts all sorts of different things in the economy and the housing market. But the number one thing that it impacts is affordability. And that has a huge drain on demand, right? Basically, for a while during the last couple of years, even as housing prices went up, mortgage rates were so low that it compensated for increasing prices and people could afford to buy more and more expensive houses. But when interest rates and then mortgage rates started to go up in turn, that's when things really started to change. And all of a sudden, it caught up to the entire housing market that prices had gone up so much. When mortgage rates returned to a more historically average level, people could no longer afford the increase, the sort of appreciated price of all the prices of all the homes in the United States. That sort of set off this cascade effect, right? So now demand is pulling out of the market. If people can't afford homes, they're going to pull out of the housing market. It also introduced a lot of uncertainty. So people who could afford to remain in the housing market dropped out because it's just getting too expensive. It's too uncertain. No one wants to catch a falling knife, as they say, buying something on the way down. And so that's what we've seen over the last couple of months. Last 6 months have been a correction. And I'm not saying that it's a crash. And I think that's a really important distinction because right now, I'm recording this in early of January of 2022. Right now, what we're seeing is that year over year, prices are still up, at least as of December of 2022. So that means when we compare December of 2022 to December of 2021, prices are still up. Not by a lot, but they are still up a little bit. And so that shows that we're not crashing. Like prices are still up year over year, which is the best way to measure housing prices. However, if you look at it month over month, you see that from June to December, housing prices dropped about 9%. And housing is seasonal. So usually from June to December of every year, you see a drop, but usually it's about 4 to 6%. Now it's 9%. So we were seeing an accelerated seasonal decline, which means, in my opinion, that we're in a housing correction. What's going to happen in 2023 is the big question I'm sure everyone wants to know. And just like 2022 was sort of this tale of two halves where we had one half where the market was going crazy, second half being a correction, I think we need to think about 2023 in similar terms where we're probably going to have a tale of two halves. I feel fairly confident that in the first half of 2023, we're going to see a continuation of where we are right now, which is a housing correction. Again, not a crash, but a correction. We are seeing mortgage rates already start to stabilize, but I don't think people are going to start jumping back into the market. We're not going to see demand recover until the Federal Reserve stops raising interest rates, mortgage rates plateau, and it maybe even start coming down. If that's going to happen, I don't know, but I don't think, even if it is going to happen in 2023, I think that's very unlikely in the first half of the year. So I don't really expect anything to fundamentally change. And I think we will start to see declines on a year over year basis sometime towards the end of Q1 and into Q2. Again, year over year declines, that happens. It is a normal part of economic cycles. We haven't been there yet. And I do personally believe that we're going to see modest single-digit declines at some point in the first half of 2023. But when we get into the second half of 2023, that's when things are really sort of uncertain. And there are different scenarios that could play out. I've talked about this in previous videos, but some of the scenarios that could play out are: one, we go into a global recession. This seems very likely. Most economists believe that we're heading towards a global recession. And if that happens, I know this is counterintuitive. What often happens is mortgage rates decline. That could help stabilize the housing market and increase activity in the housing market and prices in the second half of the year. The second thing is we're starting to see more and more encouraging inflation data. And if inflation keeps going down, the Fed will probably stop raising interest rates and maybe mortgage rates will go down. So those are two scenarios where the second half of 2023 could actually start to see the market start to normalize, end this correction, and begin a new economic cycle. However, there is a scenario where the Fed keeps raising interest rates, inflation doesn't get better, the job market stays strong, and we just see mortgage rates climb back above 7%, maybe even up to 8%. And in that scenario, I think 2023 and 2024, both years are probably going to be a correction. It's going to be a much longer adjustment, and we could even get over double-digit year-over-year declines. Personally, if I had to make my guess right now, I don't think that's the most likely scenario. I think 2023, we're going to see 3 to 8% declines year over year on a national basis, and we'll probably see the housing market bottom sometime in Q1 of 2024. That's my guess. I don't really know, though. I am just, I am a data analyst. I look at this data and I try and figure out what's going to happen, and I share with you my thoughts, but I don't really know. But the truth is, regardless of what happens, there are still ways to invest in 2023, even though the market might be correcting. And in this report, I offer 10 different ways where you can still take advantage of the opportunities that arise in 2023 if you want to be a real estate investor. And the basic premise here is that when the market is in a correction, I know that's when everyone says like, oh, you shouldn't buy. But when a market is in correction, that is also the literal definition usually of a buyer's market. It means that buyers have the leverage. It means that there's more opportunity out there. They can get concessions out of the sellers. And so that is the theme of the sort of the recommendations I make for how to invest in 2023. I'll just give you a couple recommendations. If you want us to check out the rest of them, you can do that by downloading the report. Again, it's biggerpockets.com/report, totally free. Number one is buying deep. This is the thing we talk about in BiggerPockets all the time, but basically buy under market value, buy under the list price. This is an excellent way to buy in 2023. We're going to see more inventory on the market because there's less demand and sellers are going to have to keep their properties on the market longer. That gives buyers leverage, and you can often buy under the list price. Now, over the last couple of years, that's been crazy. You couldn't do that. People were bidding 10%, 20% over the list price. But in normal markets, in normal times, you usually try and negotiate with the seller, right? You usually try and get 2% off, 3%, 5% off. Now, if you think in your particular market that prices might go down 3%, might go down 5%, then you should try and buy a property for 5% below what the market value is right now, because that insulates you from any potential downturns or corrections in asset values, but at the same time allows you to buy during a time when there's more opportunity, there's more deals on the market, and you have better choice and leverage in your negotiations. So that's one. Another one, I'll just give you two here and then we'll move on, is investing in hybrid cities. What I've been talking about so far in this video is really on a national basis. It's the aggregate of all these different regional housing markets. But really, every housing market behaves really differently. And in the report, I actually show this interesting contradiction between Philadelphia and Austin and show how they have totally different characteristics right now. And those are just two examples. This is going on throughout the entire housing market right now. But hybrid city, and basically the premise here, cities that grew the fastest during the pandemic are the ones that are going to be hit proportionally the hardest by the correction. So we're already seeing cities like Phoenix and Boise and Seattle hit 10% declines. On the other hand, cities like Chicago and Philadelphia are still growing, right? So what's happening here is that cities are basically reverting back to historical performance. Before the pandemic, there were cities that grew really quickly. There were cities that offer really good cash flow. And there were some cities that I call hybrid cities that were kind of the boring ones because they didn't offer the best cash flow, but they also didn't offer the best appreciation, and people often overlook them. Now, personally, I think these are probably the best, safest in cities to invest in because they offer cash flow, which allows you to be defensive and make sure that you are able to cover your payments. There's no risk of vacancy, anything like that, but you still have the upside potential of appreciation. And now there are a lot of cities like this. You can check it out in the report, but some of the ones I like are Birmingham, Alabama, Philadelphia, Pennsylvania, or Madison, Wisconsin. So those are just two of the 10 pieces of advice that I give in this report. You can check it out for free on biggerpockets.com/report. I don't want to get into all of the 10 things here because you should go and just read this entire report because there's tons of other context and information that you should try to understand if you are going to be a real estate investor in 2023. Go check it out, biggerpockets.com/report. If you have any questions about the report or want to talk to me about it, you can do that on Instagram where I'm at the Data Deli, or you can always message me on BiggerPockets. Thanks again. I'm Dave Meyer for BiggerPockets. Thanks for watching. We'll see you next time.